When the purity of money dies, civilization itself is next. That isn't hyperbole, it's a mathematical certainty. Welcome to the deep dive. Today, we are shifting gears. We're not just looking at history, we are conducting a survival analysis for the 21st century. We're dissecting the collapse of the Roman economy and the one man who tried to stop it. The seventh guardian, Emperor Aurelian, the Restitutor Orbis.
The restorer of the world, a title he earned in blood, not through politics. Our mission today is precise. We are looking at the mechanism of currency collapse in the 3rd century, specifically the red tape strategy, the bloody fight to restore sound money, and we are overlaying that directly onto the modern economic landscape.
So we're looking at the digital denarius, Bitcoin, through the lens of Roman survival. This is an asset move briefing. Let's begin.
Let's start with the anatomy of the crisis. We have to establish a baseline.
Right. Under Augustus, the Roman denarius was the standard, the global reserve currency of its day.
It was the trust standard, 95 to 98% pure silver. When you held the denarius, you held the physical weight of the empire's value. It wasn't a promise. It was property.
But trust is expensive to maintain, and it's very easy to steal.
And the theft, well, it began at the very top. We had the data on the degradation. It starts with Nero, AD 64.
Nero was the first to formalize it, wasn't he?
He was. The first intentional debasement. He dropped the purity to 93.5%. Now that seems small, almost a rounding error, right?
Insignificant on the surface.
But it broke the seal. It established the precedent that the state could, shave value from the currency to cover its own fiscal incompetence.
And then we fast forward, Septimius Severus, 8211, the timeline accelerates.
Drastically. Severus needed to buy the loyalty of the legions. He couldn't afford it with real money, so he just manufactured it.
He slashed the silver content.
To roughly 46 to 50%. In a single generation, half the value of the currency just vanished.
And by the time we get to Claudius Gothicus in 8270, we are in the terminal phase.
The death spiral. The coin is now 2 to 3% silver. It's effectively a copper slug dipped in a lye.
Okay, I want to pause here, because the lye part is where the sophistication really comes in. This wasn't just mixing metals in a pot. The Roman state employed what we would now call high-tech deception. We need to talk about the Antonianus and surface silver enrichment.
Right, the Antonianus, introduced by Caracalla in AD 215. It was a masterclass in psychological manipulation. The coin had a face value of 2 denarii, but if you put it on a scale, it only weighed 1.5 times as much.
So the state just decreed that 1.5 equals 2.
Exactly. And to sell this bad math, the emperor wore a radiate crown on the coin's image.
Using the prestige of the office, the divine right, to mask the theft.
But the technical fraud, this surface silver enrichment, that's where the parallel to modern banking becomes absolutely chilling.
Break that down for us. How did they achieve this enrichment? Because it sounds incredibly sophisticated.
It was state-sponsored chemistry.
Yeah.
I mean, think about the level of intention here. The mints would create an alloy that was, say, 95% copper and 5% silver. If you just cast that, it looks like bronze. It looks cheap.
So it fails the eye test immediately.
Right. So they developed a pickling process. They'd use mild organic acids, vinegar, citric compounds, things like that, combined with heat.
So they're washing the coin in acid.
They're leaching the copper out of the very surface layer. The acid dissolves the base metal on the outside, leaving behind a kind of sponge-like structure of pure silver. They burnish that down, and suddenly you have a silver skin, a few microns thick. When it came out of the mint, it shined. It looked like the old money.
But it was fugitive, a temporary illusion.
Physics always wins. As the velocity of money increased, hand to hand, market to market, that microscopic layer wore off. It physically turned brown in people's hands.
Imagine that, the psychological shock of watching your savings literally rust before your eyes.
The citizens realized the government's money was just a veneer.
That visual, the silver rubbing off to reveal the brown copper, is so explicitly comparable to modern quantitative easing.
It's the same mechanism. Modern states expand the money supply to service their debt. They wrap it in complex terminology. They use the prestige of the central bank, their version of the radiate crown. But the effect is identical. They're using acid to dissolve the purchasing power of the currency while telling the public it's still sound. It is a lie about value.
And lies have consequences. The market always finds the truth. Let's look at the explosion. The inflation metrics from 8200 to 300.
We're looking at a price explosion of approximately 15,000% in 1 century. But percentages can be abstract. Let's look at the wheat index. This is the cost of survival.
Okay, so the price of a modius of wheat, about 2 gallons. In the first century, our baseline, this was 6 drachmae.
Stable,
Yeah.
predictable. By the AD 270s, that same amount of wheat is 200 drachmae, a 33x increase.
Okay, 33x is bad. That's a serious crisis. But then we hit AD 334.
78,000 drachmae.
Wait, run that back. 78,000.
Yes, from 200 to 78,000 in roughly 60 years.
That isn't inflation. That is the end of money itself.
It gets worse. By AD 344, just 10 years later, that same measure of wheat is over 2 million drachmae.
2 million. So the currency is effectively confetti.
Confetti might be too generous. The engine of the empire didn't just stall, it disintegrated. The monetary economy itself ceased to function.
And this is a critical point that often gets missed. It wasn't just prices went up. Society structurally collapsed. What does that actually look like for the average person?
The division of labor died. I mean, if you cannot trust the medium of exchange, you cannot trade. If I grow wheat, you make shoes, I'm not trading my real wheat for your coins. Why would I? By the time I get to the next village, they might buy half as much. So I stop selling my wheat, I hoard it, I eat it.
The economy reverts to subsistence farming.
And the government knew it. They eventually refused to accept their own worthless coins for taxes. They instituted the annona militaris. They demanded physical goods, grain, cattle, leather, directly from the farmers.
When the government won't take the money it prints, you know the game is over.
Precisely. And the social consequence was the creation of the colony. Free citizens, unable to survive, were forced to sell their liberty. They became serfs, tenant farmers, tied to the land of the wealthy, just to eat. That complex, urban Roman economy collapsed into a primitive manorial system. This is what we mean when we say a currency that loses its purity kills its civilization.
And it was against this backdrop of total collapse that Aurelian steps in. And this wasn't a policy debate. It was a war. The bellum monetariorum, the war of the mint workers.
One of the most fascinating and under-discussed events in economic history. Aurelian realized that to save the empire, he had to secure the money. But the mint at Rome wasn't just a factory. It had become a criminal cartel.
The villain here is Philocissimus. But let's be clear, he wasn't just some middle manager skimming off the top.
No, Philocissimus, the head of the mint, was effectively a warlord. He was running a massive internal theft ring. The mint workers were clipping the edges of coins, stealing the silver meant for the alloy, replacing it with junk metal. They were debasing the currency for personal profit.
So they were accelerating the very inflation that was destroying the state. They had become a sovereign power within the state.
And when Aurelian orders a stop to it, Philocissimus refuses. And it escalates into a full-scale battle on Killian Hill.
This wasn't a riot. This was a pitched battle.
Aurelian had to deploy his elite legions, these battle-hardened troops, to dig the mint workers out of their fortified positions. The casualty count, 7,000 soldiers.
7,000 elite soldiers dead to stop a mint manager? That sounds insane.
That number is higher than many frontier battles against barbarian invasions. It shows you the scale of the corruption, how deeply entrenched this deep state of the mint actually was. They were fighting for their right to steal from the populace.
And Aurelian understood a brutal strategic truth.
Military loyalty cannot be bought with worthless copper. If he didn't fix the money, the legions would turn on him. He had to execute Philocissimus and crush the mint workers to reset the entire system.
He paid a high price for purity, but he won the hill. And that victory led to the XXI protocol.
The reform of AD 274. Aurelian introduces a new coin, the Aurelianianus, and he stamps it with a code.
Explain the code. What did it mean?
The most likely theory is that it signified a guaranteed ratio, 20 parts copper to 1 part silver, roughly 5% purity.
Which sounds low compared to the Augustus era. If I'm a Roman citizen, why am I excited about 5% silver?
It is low. But the critical shift was not the amount of silver, it was the transparency. This is the philosophical pivot. Aurelian stopped hiding behind the radiate crown, behind royal authority. He stopped saying, "Trust me, I'm the emperor."
Instead, he stamped the math directly on the coin, XY. Here is the ratio. Verify it.
This is the birth of verification over trust. He moved the basis of value from the whim of a ruler to a verifiable physical standard. He was admitting the state had lied and committing to a mathematical truth going forward. He was saying, I'm not asking you to trust my face, I am asking you to trust this ratio.
Okay, now we need to bring this forward. We're looking at this history because it is repeating. The Roman surface silver enrichment is the direct ancestor of modern central bank policy.
We are living through a digital Killian Hill. The modern central banks, are the spiritual descendants of Philosissimus and his mint workers. They are stealing the weight of time from the currency. When they print trillions, they are clipping the edges of every dollar, every euro in your pocket. They are diluting the energy you expended to earn that money.
And just like in AD 274, there's a paradox when you try to fix it. We call it the Aurelian paradox.
This is crucial for understanding the current market. After Aurelian crushed the mint workers and issued the honest XXI coin, inflation didn't stop. It spiked.
Why? If the money was better, why did prices go up? That seems completely counterintuitive.
It was a trust reset. For decades, the market had been forced to pretend the fake money had value because the state said so. When Aurelian introduced the XXI standard, he effectively admitted the old coins were trash. So the market stopped pretending. They repriced everything based on the actual silver content, not the face value. The reform forced the market to confront the reality of the debasement.
So you're comparing Aurelian's XXI reform, which was meant to stabilize things, to Bitcoin, which is notoriously volatile. To an investor, volatility looks like risk, not stability.
That's the standard view, yes. But look at the data from AD 274 again. Volatility isn't always chaos. Sometimes it's price discovery. Bitcoin acts like the XXI coin. The volatility you see isn't the asset failing. It's the rest of the world trying to figure out how to price a fixed asset in a debased currency. It is the pain of the world readjusting to a purity standard after living on debt for 50 years. It's the Aurelian paradox playing out in real time.
Let's deepen that synthesis. You call Bitcoin the digital denarius.
It is the only asset that fits the profile. Look at the Lindy effect.
For our listeners, break down the Lindy effect quickly.
Simply put, the longer something non-perishable, an idea, a technology has survived, the longer it is likely to survive in the future. Time is the ultimate stress test.
Aurelian was assassinated, so his reforms didn't fully take root, but his logic survived.
The logic of hard money survived 1,700 years. Bitcoin is 15 years old. It has survived over 400 death notices. China banned it. Politicians mocked it. The technical assaults have been relentless. Yet its Lindy score is 85%. It is statistically significant. It's not a startup anymore. It's a survivor.
And it possesses algorithmic purity.
And this is the key evolution. Aurelian tried to guarantee purity with a stamp and a sword, but emperors die and swords rust. Bitcoin matches Aurelian's XXI spirit, but it secures it with code.
The 21 million supply cap.
The genius of the XXI stamp wasn't the ratio itself. It was the transparency. The XXY of our time isn't a stamp on metal. It's the algorithm. Bitcoin's 21 million hard cap is the digital version of the XXI stamp. It is immutable. No central banker, no politician, no mint worker can clip a Bitcoin. The supply is fixed by mathematics, not by decree.
It's the removal of the human from the corruption equation. Purity through verification, not decree.
It's the digital denarius because it serves the same function the pure denarius did. It's the final resistance against the civilization that has chosen to silver plate its debt.
So we have the history, we have the modern parallel. The question for our listeners, for the strategists, is what to do with this intelligence.
You look at the behavior of citizens in the 3rd century. When they realized the government was lying, what did they do? Did they hold the copper? No. They engaged in what we call Gresham's law.
Bad money drives out good.
Right. If you have a pure silver denarius and a copper one that the emperor says is silver, which one do you give to the shopkeeper?
I give him the copper, I keep the silver.
And so does everyone else. The real value, the silver, disappears into hoards, hidden under floorboards, leaving only junk circulating. They drained the empire of real capital.
That is the asset move.
The architects of wealth today are doing exactly the same thing. They are dumping paper, which is the modern silver-plated copper, and they are accumulating the only thing with fixed mathematical purity.
You can't build a future on a foundation that dissolves in your hands. The lesson of Rome is that when the state turns against the currency, the only safety is in assets the state cannot print.
Aurelian fought a war to put XXY on a coin. He understood that without verification, there is no civilization. Today, we don't need a war on Caelian Hill. We have the ledger. We have the code.
Purity is the only shield.
And mathematics is the only purity that lasts.
In the 3rd century, the smart money exited the system to survive. In the 21st century, the exit door is open. But it won't stay wide open forever.
Identify the silver plating in your own portfolio. If it relies on a promise, it's plated. If it relies on verification, it's pure.
That is the strategic imperative. The 7th Guardian has shown us the way. The XXI protocol is now live. Strategize accordingly. This has been The Deep Dive.